Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And sources say Eric Balchunas is back.
Just in time for the hot weather and maybe hot inflows.
Yeah, well, let's talk about some of that right now. The biggest stories right now in the nearly $13 trillion global ETF industry. First half of 2024 has flown by, with stocks really sustaining that record rally. We're going to discuss what, if anything, can slow down this bullish run.
Funds have been flowing into India and Japan. We speak about any potential risks investing in those countries with Jeremy Schwartz, Global CIO at WisdomTree.
And BlackRock strengthens its active ETF platform with 2 new active funds. We'll discuss them with Jay Jacobs, the firm's head of thematic and active equity ETFs. But as promised, Eric Balchunas from Bloomberg Intelligence back with us now, and he's taking a look at those flows. Eric, welcome back.
Oh, it's great to be back, Katie. Thank you for that nice intro, and Scarlett as well. So let's look at the flows. There is a lot of hotness in the flows to speak. ETFs, we think, might even break their all-time record this year. If you look, IVV with $9 billion, that is a ton. Now, I will say there's some tax rebalancing going on this week. So some of this stuff, like cows, for example, that's not real. That'll come out probably tomorrow. But in general, we do see a lot of the Vanguard bit in particular coming in as usual. Let's look at the outflows, though. And you can see some of the trading crowd money got a little spooked by NVIDIA getting sold off. Like money coming out of SPY and the Qs. Again, I think it's probably NVIDIA related. XLV Healthcare, and then Soxel again. That's semis, and XBI is biotech. So clearly a little trading crowd spook, but largely everything is still relatively bullish as usual. Let's look at the international markets. We rarely talk about what's going on because we're so focused on the U.S. But if we look at the top single country ETF categories by flows this year, India is at the top, and then Japan, South Korea, Taiwan, and Argentina. Now, if you look at the net flow numbers, 4 billion, 4 billion, 1 billion, they're not massive, right? You know, overall, ETFs have taken in 390 billion, so these are small numbers, but these represent like 20, 25% jumps in the assets of these categories. So for these categories, these are big. Argentina in particular, that's a 100% jump, believe it or not. A lot of it is based on new elected leaders and whatnot. So some of these areas are definitely doing pretty well. I mean, obviously the U.S. dominates, Katie, but there's definitely some hot spots elsewhere.
All right, Eric, thank you. And joining our conversation now is Jeremy Schwartz. He is Global CIO of WisdomTree. And it's hard to know where to start, whether we're talking about India or Japan. But let's start with Japan, because I take a look at your product lineup. DXJ has taken in nearly $1.3 billion so far this year. And DXJ, of course, it hedges the currency risk. So how much of that inflow is just people hiding from what we're seeing when it comes to yen volatility?
It's interesting because I think this has been one of the biggest mistakes investors have made over the last decade. You know, the yen's at 160. It's down considerably from where it was 10 years ago. Even just 3 years ago, it's down. It's had a big move. And still, there's probably 4 times as much in unhedged ETFs. And I keep telling people, why are you betting on these currencies? The stocks are cheap. This is the classic Buffett trade. He's been buying all these trading companies, and he's issuing yen bonds, so he doesn't have any of this currency volatility. You get paid 5% to hedge. People thought it was expensive. You're getting paid 5%. And so it's been a great place, but still people have been betting too much on these currencies.
Can you talk a little bit about the costs to hedge the currency from your end as it moves in large measures? And of course, as we talk about, it's been weakening quite a bit. How much does that cost for you, and at the end of the day, for the investor who might pay for it through fees?
Well, this is a very interesting thing. I call it a better than free proposition in a sense that you're paid. So when the U.S. has a 5% interest rate, and their Bank of Japan went off of negative to 0, that spread between the foreign interest rate and our interest rate is how much you're paid. So in India, it would cost you 2% because their interest rates are higher, but in Japan, you're paid 5%. You know, so I think it's one of the big misperceptions that it's costly. It's costly for Brazil. It's costly for high interest rate countries, but you're paid this extra carry to neutralize it in the developed world.
So it's the carry trade built into the ETF, essentially.
Yes.
You guys getting deja vu? Because
the first show.
This guy was the first guest on the first ever ETF IQ, must have been 6 years ago, talking about the same thing. Back then, currency hedging was like all the rage. It was like a craze. Then it kind of underperformed. A lot of people left. And now it's come back, and it's outperforming. But we have this phrase called, do you get a second bite at the apple? Has it been hard to get investors back in? Ones who were in the trade, went down, they got out, now you want to get them back on the ride. Has that been tough?
Well, I think people are using it more strategically. Like, we still have about 10 billion in the category from our broad international quality-driven growth, which is now bigger than our European product. And we're seeing it in model portfolios. People are adding it as a strategic position. We've been starting to think about it that way. So I think people are starting to say, well, why am I taking this currency volatility? Do I really get paid to do it? And yeah, it was certainly a hot place 10 years ago, but people are rethinking about it strategically.
How much education do you have to do? What you're describing, like you say, this is such a big mistake that people make all the time, but you take a look at DXJ and you read the description, and that might not be so intuitive to maybe just the casual observer who comes across this ETF. How much time do you have to spend on education in conversations with investors and financial advisors?
Oh, for sure. It's a big educational thing. And part of it is benchmarks. People say, well, my benchmark has dollars. Am I making a call on the dollar? And so it's a circular conversation of like, what is your benchmark to say what is default strategically your baseline? So there is some education, but I think as people see the history that you lower volatility, it really has been a helpful thing to do.
Okay, remove the yen's weakness from the equation, which is essentially what DXJ does. What do the corporate fundamentals of Japan look like right now?
To me, I've been saying Japan could outperform the U.S. because you're starting with this 5% how much you're paid. They've got 2.5% dividend yield, so twice the S&P 500. 14 PEs versus 21 PEs for the S&P. They're growing dividends because of the corporate governance reform. So the fundamental case is actually very, very strong. You've got people moving away from China strategically with all the geopolitical. India, you talked about, was a benefit. Japan's a benefit. And so the fundamentals are there. Very attractive, growing the dividends, plus the 5% carry.
I get all that. It resonates with me. But I feel like people say that all the time about international. The fundamentals always look good. And yet the Qs just plows over them year after year. And it just seems like people are like, it's going to take a couple years of outperformance for people to get off the Qs and move money internationally. Do you disagree?
Well, they always say it's cheap for a good reason because there's sort of these value traps where you get a lot of, when you think about the international market versus the US, you have the big tech stars, and then you don't have any of that internationally.
Right.
Japan actually outperformed the NASDAQ during much of the last few years. It's been like trading like an AI stock, and they do have semiconductors. And now they were in a bear market for 30 years as the Nikkei deflated from like the biggest bubble of all time. So they're even trying to, all their investors, their local investors were in cash. They're now trying to reinvigorate them with equities. So there's still, I think, a long runway ahead of that type of market.
Well, let's talk about another market outside the U.S. that investors are very excited about, and that, of course, is India. You take a look at EPI, for example. That's your India ETF. Big inflows year to date, over $1 billion. The performance, not too shabby either, almost 16%. You think about the political turmoil that we've seen there, the volatility that maybe certainly doesn't seem like markets were expecting. Do you think that could sort of cool some of the big inflows that we've seen?
I think this is a multi-decade story. So India has got the best demographics of the world. It's got some of the best GDP growth, per capita income that should rise. They're trying to bring people out of the countryside into sort of the traditional, what China did 30 years ago, is sort of the development prospects of that. So this is not just a short-term thing. We think that this is one of the best long-term stories. And now when you got a market like that gets so hot, you got to think about how you weight it. You don't want to just be in the most expensive stocks. It's a valuation-sensitive approach that we've done. We're also the broadest. When you look at it through the MSCI, it's 125 companies. We have close to 400 to 500 companies in our basket. So it's sort of interesting as it's most representative. That's what's been leading to the performance. The mid and small caps, actually value has worked quite well there. And so it's a long-term, multi-decade story.
We keep talking about India vis-a-vis China. How much of the inflows into India is driven by the fact that it is not China, in that investors need to replace China in their portfolio because they see it as uninvestable, and India serves as the next big anchor EM country?
You do see that in the diversified emerging market flows. EM ex-China has definitely resonated and been the leader for even the broad diversified funds. And I think this Japan and India together are people viewing this as the Asia pivot. So I do think there is some of that, but it's the growth story. People are saying this is the fastest GDP. They want exposure to the consumers. So it's as much about China pivots as well as the local growth story of India.
Yeah, but isn't now the time to go into China? Because the Chinese government's not going to do a bunch of QE, and the market's been beaten up. It almost seems like your fundamental story would apply to China more than the other countries.
People keep trying to time the bottom of this China market and say, does it become so beaten down? And I'm sympathetic. The tech stocks are trading like value stocks of the lowest valuation they've had. But it is a challenge. The tensions with China don't seem to be going away. It's the only thing that unites the politicians is who can be tougher on China. And so you're going to see more trade back and forth. And maybe we'll see if we have any of that news at the debate this week. But it's just a very tough place to be strategically allocating.
All right, Jeremy, great conversation. That's a good place to leave it. Hope to see you back again soon. Our thanks, of course, to Jeremy Schwartz of WisdomTree. Now, coming up, it's a hot ETF summer. I think that's a Megan Thee Stallion reference. U.S. funds on track to set a new flow record, and there is potentially no end in sight. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Schwartz fleeing the market. You take a look at SPY right now. You're taking a look at the percentage of shares of its free float that have been shorted, and that number has dipped below 10%. That is close to a record low here, as you can see in data going back to 2018 or so. So a lot of people rushing to one side of the boat. We'll see whether that works out for them. But let's talk about active managers, because they haven't exactly been performing all that well. You take a look at equity ETFs that have been outperforming the S&P 500. Just 23% so far in 2024 have managed to best the benchmark. As you can see, 2022 was a pretty good year. That, of course, was a down year for the S&P 500. It's a lot harder to beat the benchmark in a year when it's rising, and it's all been driven by one stock. And let's end, though, with U.S. inflows, because they've been pretty spicy. You take a look in orange, these orange bars that you have. So that is the average. And then you take a look at those blue dots, if you can see them. Those are the 2024 dots. So, so far in 2024, of course, the flows into ETFs on a monthly basis have beaten the long-term average, Scarlett.
Yeah, but you look at that chart a little more carefully. What's interesting is that there is no dot there for March and May, because they're off the charts. I mean, we couldn't even fit them in because they're so much higher than the long-term average.
Yeah, couldn't shrink the y-axis enough to get those in there. And that really just speaks to how people have been happy to shovel their money into the stock market, into these big benchmarks that have continued to power higher, with the likes of NVIDIA just on a tear. Yeah, NVIDIA boosting the index overall. You know, according to Goldman Sachs' trading desk, there's a wall of money coming in July. You know, that would be at the start of a new second half and the start of a new third quarter that they see fueling the continuing rally in U.S. equities. They also see a reemergence in retail traders during the summer, and they tend to usually come in around July. So we'll see if that all plays out. July is just a couple days away, so we'll have to see.
All right, coming up, we drill down into new active ETFs, speaking of which, from BlackRock with Jay Jacobs. He is coming up next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence. Back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we're looking at BELT, which is an intriguing new ETF from BlackRock. A little out of their comfort zone. BlackRock brand is where their active brand. So it's long-term U.S. equity. It looks like an average active fund. It is different. I'll explain in a minute why. The fee is 75 basis points. As you can see, it just came out in June. Boom, it's actively managed. That's important to know. Basically, this is looking through stocks. You can do international as well. Looking for fundamentals, it says here, franchise strength and reinvestment opportunity. It's an active stock picker trying to beat the market. Let's look at the cross-section of the portfolio in the top 10 holdings. And the first thing that sticks out is how big the weightings are. Look, Microsoft's 12%, 7%, right? You look, here's the stocks you own. You don't own much more because it only owns 25 stocks. That is highly concentrated. And this is important for that 75 basis point fee because it really hits on something we call beta adjusted fees. Let's look at this chart that we use in BI all the time, where we look at active share in one grid, which is how different are you from the benchmark, and then fee over here. And we looked at the top 10 most successful active equity ETFs, and you can see they're all sort of above this 45-degree angle, meaning that if they're low active share, meaning not different from the benchmark, they got to be low fee. People only want to pay for the active, not the beta, because beta is now free. Well, ARK is a great example of being high active share but charging a lot. but it's, as long as you're above the line, you have a good shot at flows. Belt is right there. So Belt is a little like ARK in that regard, and people are a little more willing to pay when it's a small allocation. So, Katie, it's in a good shape, but it's got to deliver the returns now, and that's the hard part.
All right, Eric, thank you so much. And joining us to talk about this ETF, I am thrilled to say, is Jay Jacobs. He is U.S. head of Thematic and Active ETFs over at BlackRock. So let's talk about Belt. You take a look at the portfolio managers. One of them is Alistair Hibbert, who, if I remember correctly, he manages one of BlackRock's largest hedge funds. So what does it say that you have one of your hedge fund guys managing an ETF over, in the iShares franchise?
It's really about taking our world-class managers and bringing them into the structure that is increasingly the vehicle of choice, particularly among advisors, amongst RIAs, and even more narrowly amongst model managers that are building ETF models that they can scale and make repeatable to their clients. So this is just about matching great managers with a great vehicle.
Sounds like BlackRock believes that in the whole star fund manager idea.
Absolutely. I mean, we have plenty of great managers across our platform. We brought out a Rick Reeder ETF Bank last year, which has brought in $3 billion in assets. We're bringing out the Alistair Hibbert product. We've brought out a Tony DeSpirito product, investing in value stocks. So it's really about taking those managers that, in many cases, they've established great funds and great performance in the mutual fund structure, now bringing them into the ETF.
Now, obviously, we come up with that beta-adjusted fee demarcation line, which is a little like my equals MC squared. Do you guys find the same thing when you talk to people that you either have to be cheap or shiny, whether you're active or passive?
What we want is differentiated alpha, that if you are going to go into an active manager, you want to be getting something different and you want to have a real edge within that difference. So when we look at Belt, really we see clients using this as a barbell approach. Get your low cost, broad, tax efficient, super liquid IVV exposure in your core, and then barbell that with something that's going to give you a little more alpha on the side.
So yes.
Yes, I mean, in the sense that we want to have that active share, absolutely.
Did you get the idea from my chart?
No.
Okay.
No. This is about bringing out alpha strategies into an ETF.
Could you just tell him yes? I feel like that would really...
I do think an important thing here...
We're just saying it
no,
differently.
and I think an important thing, what we do look at is active share. And so what we look at with Belt is that this is 80% active share. This is very different from the S&P 500. And that's important to us. We believe if you're going to create this barbell, you can get that cheap IVV exposure, but you want something different.
I think that's so interesting, that high active share, because if you take a look at recent launches across the industry, not just BlackRock, it feels like ETFs, the active equity ETFs, have been getting more and more concentrated, that if you're going to take a swing, it might as well be a big swing. And with that in mind, you think about a product such as Belt. I mean, how much of an allocation makes sense when you think about a holistic portfolio?
Oh, we've seen 10, 15, 20%. And the reason I can say this is there's another fund. This is a little bit differentiated, but Alistair Hibbert also runs a mutual fund, the BlackRock Unconstrained Equity Fund. And we've seen people allocating at that 10, 15, 20% level in their equities. So people get really comfortable with this barbell. What it really comes down to is how do you want to manage tracking error? This is a high tracking error strategy. IVV is basically zero tracking error. It's tracking the S&P 500. So how do you want to kind of control those two levers to manage your active risk?
If this were a passive fund, you'd have a rebalancing frequency of probably once a quarter or maybe once every 6 months. How often does Alistair Hibbert change up the stocks in the portfolio, given that it's a pretty small holding in terms of 20, 25 names?
Yeah, very infrequently. So turnover is less than 20% annually in this portfolio. We expect that your average position is going to be held for over 5 years. It really is a long-term unconstrained equity fund. The idea is, how do you pick stocks today that have powerful moats around them with established businesses that are going to compound earnings, have structural tailwinds behind them, and fiscally conservative management teams to really compound and grow those earnings over the long term.
All right, and let's look at another one you launched, which is BBHY, or BRHY, sorry, which is an active high yield bond ETF. This makes a lot of sense to me. If you look at the numbers, high yield managers really do a lot better beating the benchmark than active equity managers on the whole. So I see that this one's a little less active share, right? You hold 800 high yield bonds, HYG holds 1,200. So you're not that concentrated, but your fee's lower at 40 basis points. So that sounds also like it's similarly looking at that line that we just showed.
Yeah, and this is an example of taking a strategy that exists very substantially similar in the mutual fund structure today, which is the BlackRock High Yield Fund, and bringing it out in an ETF. It's the same portfolio manager, same objective. So it's really bringing that strategy into the ETF structure. Eric, what I think you'll appreciate is just how much a lot of our active strategy is driven by models. So if we look at the last few years, from 2021, about 1 in 5 models allocated to active ETFs. Now it's 1 in 3. So you're seeing a lot more models allocating to active ETFs. And the average position to active ETFs in those models has grown from about 2.5% to over 6%. So more models allocating to active and bigger positions in active going forward.
Well, I want to talk a little bit more about BlackRock's overall active strategy. Of course, we're talking about these two recent launches. BlackRock has been more actively launching active funds. But if you think about the universe overall, I mean, active ETFs are so far dominated by JP Morgan, Dimensional, Capital Group. It's not an area which BlackRock dominates, which is pretty rare in the ETF world. So what are BlackRock's ambitions in this space? Do you want to be number one?
Absolutely. And this is really about building our active offering in the ETF structure to complement our active offering that exists in mutual funds and SMAs and CITs. So really, when we go to clients, we have a full complement of strategies across different vehicles. We've grown it substantially. Just over the last year, we've about doubled our active ETF offering from around 20 funds to now 40 funds, and we're at $25 billion in assets. So we are really investing in this space to bring out the right vehicle for our clients.
Are you seeing the growth in active ETFs come in any way at the expense of your passive products?
No. The passive products continue to grow.
Coming in.
Well, the asset management space, generally continues to benefit from new money flowing into it. I think what's great is you see investors shifting from picking individual stocks to buying ETFs. So that's people going into passive and active. You see the growth of models, which is really systematizing exposure to ETFs, whether it's index and active. So this isn't either or. This is really both passive and active growing together.
Okay, 60 seconds. Ether spot ETFs are with the SEC. They're probably going to be approved soon. When are they coming out, and how much marketing firepower are you going to put behind this?
Well, I can't talk about filings that are with the SEC today, but what I can say is we've been thrilled with the launch of IBIT, our Bitcoin ETF. We've raised over $20 billion in that fund since January of this year. I think what it's highlighted is just tremendous appetite for digital assets in the ETF vehicle. So just like we were talking about active making its way into the ETF vehicle as a vehicle of choice, for digital assets, it's solving being able to buy it in your brokerage account, sitting alongside stocks and bonds. It's making taxes more, simplifying taxes, tremendous liquidity with penny-wide bid-ask spreads. And we're bringing out that education to advisors who previously really haven't had access to these assets before. So I think continuing to invest in our digital asset space is going to be key for us.
I mean, IBIT flows year to date have just been insane. We barely even touched on it, so we'll have to get you back again soon. Our thanks, of course, to Jay Jacobs over at BlackRock. And if you just can't get enough of ETFs, good news, subscribe to my weekly ETF IQ newsletter that covers the industry. But sadly, that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Eric Balchunas and Scarlett Fu, and this is Bloomberg.